When you do it properly, there's actually 3 ways that you can make money. Hey everybody, welcome back. Today I have Kelly Allen on the show. She's the branch manager of Synergy One Lending, and she's going to talk a bit about what the rules and regulations are for getting a mortgage on an investment property or on a second home. And then after that, I'm going to come back and give a few of my own thoughts on what the possible upsides and downsides are of owning an investment property. So let's listen in. What about investment properties? And I guess maybe I'll put sort of land into that as well.
So a land loan is not a conforming mortgage product because there's no real collateral, right? The collateral for us, again, thinking it from the bank's perspective, is the house. Mm-hmm. So a land loan is not something that we do. I can tell you there's lots of banks that do land loans and you can get them very easily, but we just don't, that's not part of what we do. As far as an investment property goes, we do anything 1 to 4 units. So up to 4 units, so single family, duplex, triplex, or a fourplex. After you get past 4 units, then you're considered commercial, and that requires a commercial loan. So we have different interest rates, different down payment requirements. It's a conventional loan always on an investment property, but there are different interest rates and down payment requirements just based on the risk to the lender. So just good to know going in and knowing that you're probably going to see anywhere from, I would say, 3/4 to maybe a 1.25 difference in interest rate for an investment property to the higher side. Yeah.
And then as far as down payment, I know some lenders require 25%. What range kind of can you guys offer usually at Synergy One?
Yeah, so single family is 20% down, and then anything 2 to 4 units is 25%. So when you get into that multifamily, you have to have a little extra down payment required, that extra 5%. But your regular single family home is 20% down. That avoids you having mortgage insurance. There are some products out there for 15% down, but then that adds mortgage insurance to the payment as well. And that is kind of fluid. We see mortgage insurance companies sometimes insuring investment properties, sometimes not. For instance, right now in this whole COVID environment and where things have kind of gotten shaken up with regard to programs and stuff, that's one of the things the mortgage insurers pulled back and said, we're not going to insure any investment properties. So now your minimum payment is going to be 20% off the top. Even if Fannie or Freddie would allow the 15% down, the mortgage insurers are saying we're not going to insure them. So you don't have any outlet for the insurance. Yeah. And
I know that you've told me this in the past. You don't allow gifted funds, right? The money sort of has to be seasoned in your banking account for a while.
That's on an investment property, correct?
Yeah.
So on investment properties only, the funds have to be your own. So no gift money allowed. And then, of course, on all loan products, you want to make sure that you're not borrowing money to put as your down payment, whether it's owner-occupied or non-owner-occupied. No borrowed funds are allowed, meaning you can't go pull some money off your credit card. You can't borrow money from the guy down the street, whatever. You can do gift funds on owner-occupied, but not on non-owner-occupied.
And how do you determine what gift funds is? How long does it have to? How do you know that it's not been gifted to me? It's been sitting in my banking account for a certain amount of time.
Yeah, so we're going to get your most recent 2 months bank statements when we qualify you for the loan. So if there's a large deposit on those most recent 2 months bank statements, I'm going to ask you where that money came from.
Right. Oh, I just happened to make a lot of money yesterday.
Right. If it's a big amount, we're going to say, what have you been doing?
Right. Let me give you 2 key takeaways from what Kelly was saying. Number 1, to get an investment property, you're going to have to put more money down. The down payment is usually between 20 to 25%. And that's because the bank realizes that there's more risk. If you have 2 homes and you can only make the payment on one of those homes, which house do you think you would naturally default on? The one that you're currently living in or the one that your tenants are living in? Obviously, it's much easier to give up a home that you're not living in, and the bank realizes that. And number 2, you're going to get a higher interest rate on an investment property. Well, what are some possible upsides to investing in real estate? Well, when you do it properly, there's actually 3 ways that you can make money. Number 1, there's the monthly cash flow. What you charge your tenants is going to be more than what you're paying on your mortgage. So let's say your mortgage is about $1,000 per month and you're renting out the property for $1,300 a month. Well, there's a $300 difference that you're going to make every month. You're going to make $300 in cash flow. Number 2, the tenants are paying down your mortgage every month. And then number 3, the value of your home is also going up. And the other thing I like about investing in real estate is that you get to keep 100% of the profit, but you don't actually own 100% of the asset. So let's say you own a home and you've only put 20% down on the home, but over the course of the year, your home went up $50,000. Well, you don't get to keep only 20% of that $50,000, you get to keep 100% of that $50,000. But there's also some downsides to investing in real estate. Number 1, the value of the house could go down. Now that's the same with all real estate and all investing, but that is a possible risk. Number 2, you also run the risk that the tenants might not pay. I was talking to a friend of mine who had an investment property, and he said that his tenants didn't pay their rent for an entire year. And they also trashed the place. So he was out tens of thousands of dollars because his tenants just decided that they didn't want to pay the rent. He took them to court, and it took years to go to court, and he never saw the money anyways. Number 3, the tenants might wreck your home. And as you know, it's quite expensive to fix things in your home. You have to fix a door, fix a wall, fix a window. All of those things add up pretty quickly. And number 4, you also run the risk of possibly not being able to find tenants. Let's say your mortgage every month is $1,000 and it takes you 3 months to find tenants to move into your place. Well, that's $3,000 that you have to pay out of your pocket to continue to keep that house. So there's definitely some risk in investing in real estate, but there's also the potential for some high rewards. Thanks for watching this video. I hope it was helpful. I hope you got something out of it. If you haven't hit the like button yet, do it right now down below. Feel free to subscribe as well, and I hope to see you in the next one.